Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis. I am the founder of Intelligent Investor and host of this episode of Stocktake, which we might call the Rant edition. We're going to be talking about things that piss us all off in finance, of which there are many. I think we're going to start off with, I've got Nick here. Good morning, Nick.
Morning.
And Gaurav too.
Good morning.
Graham's having a break from the podcast because he has a very busy week with all the healthcare stocks he's got to write up this week.
Also, Graham is just not the ranting type, is he?
He's not a ranter.
No.
He's not a ranter. He
Nick
really
and I
doesn't
are the
fit
ranters.
in that regard. Every other regard is just fantastic, but he just doesn't seem to get angry enough about things in life.
What's wrong with him?
Get more angry, Graham.
Yeah, let's rant about
Angry Graham. That's what I'll call him in the next podcast, I think. Yes. Okay. So let's kick things off. Gaurav, Telstra reported, when was it? Was it Friday? Was it Monday? I can't remember.
I think it was Monday.
Yeah. We've had a buy on Telstra a few years ago. We've done quite well out of it, but this week you decided to get out of it. Part of the reason is the way that they reported their results. What was it that really upset you about the way that Telstra reported this week?
I've always found Telstra a little bit mind-boggling. One thing Telstra has always done is they keep changing the segments. So mobile, which is by far their most important segment, sort of 60% of earnings and the highest quality part of the business. They always move it around and shuffle around. Broadband, they sometimes include enterprise, sometimes they take it out. Sometimes they include consumer only, sometimes they take it out. So there's this constant shuffle of segments, which makes it difficult to create a time series of profits. And that's long been a complaint from me about Telstra. But this year I had several other complaints to overlay on top of that, which made my ranting.
Before you go on to that, why would they not be consistent about that?
Yeah. Look, I don't think there's anything nefarious about that. I don't think they're trying to hide anything when they do that. I think that is just, that kind of tells you about the internal mayhem of Telstra. They're trying to reorganize the business and trying to find growth options and shuffling segments here and there. I think that does reflect sort of genuine internal changes going on in the business, but it's still not a good sign that they haven't got those segments sorted out. Look, I must say, over the last 2 years or so, particularly under this particular management, that concern has been less of a problem. It's much clearer now, and they're better at taking out at mobile and taking out all the important segments. They've lumped all the infrastructure businesses into one group, which is just incredibly useful. Useful for them because it shows you how good those businesses are, but also useful for an investor. They can track the earnings. So look, that's more of a legacy complaint, but there are new ones. Don't worry, there are new complaints I got now.
Oh, good. Let's get into them.
Starting with, they've always, the first line of any report ought to be revenue, right? So when you open the result, the summary should have the revenue at the top, and indeed that's what Telstra has done every year. And this year, the first thing I noticed was, where's the revenue? Why have they left off revenue? That's really weird. And they left it off because it was negative. And it really, if you're the kind of management that's going to leave off bad information, it just pisses me off.
Not just bad information, but you want to know revenue growth and you want to know profitability growth more than anything else. You're leaving off one of the two key things in a result.
And just think about the process that went through, right? Like the minion that put that deck together would have used last year's deck and just updated it, taken it to someone, and someone very high up would say, oh, that's negative, we better take that out.
Yeah.
It's that kind of thinking that really gives me the shits. For me, that is a sell by itself. Like I'm not interested in investing in this company now because I just don't trust. If they can't tell you the bad, and it's not even bad news. The revenue was down 1%, and even that made them take it off their presentation on the summary. So, what else? What else are they hiding? And there's clues to that. I can answer that question for you, actually. What else? They've now come up with this new metric, this cash earnings metric, right? Which, look, it's probably not as bad as it sounds. I really don't like adjusted earnings. I just think it's a legal way to be dishonest most of the time.
It really depends on who's doing the adjusting.
Look, I think almost always it's a bad idea. Gold companies used to do this all the time. One of my pet peeves with oil businesses is they continue reporting using EBITDAX, which is all our profit and none of our costs. These are big, heavy industry businesses, and they just ignore all their costs and give you their EBITDAX. So this is very, very common. And the good businesses really stand out for their clean reporting. And Telstra is a big fat fail this year because these cash earnings, they really flatter the business. I mean, I went through the numbers in the review, and I don't need to repeat them here, but we're talking about sort of flat statutory earnings and cash earnings that are up sort of 15%. So, you can guess what they put in the forefront. Cash earnings up 15%. Now, the difference between the two is really just they've just excluded a whole bunch of costs, things like spectrum leases. They make these strategic investments. They just excluded them. Well, we don't do that every year. They're not costs. These are our cash earnings. And look, they're in Telstra, it's long been the case that the cash flow is stronger than the statutory numbers because of it's a very capital intensive industry, and they invest and they capitalize all their costs, all their expenditures onto the balance sheet. So you do get a big depreciation charge, which isn't always met with business as usual capex. So that gap has always been there. But I just felt as though this year, the combination of just leaving revenue off and then just really honing in on these cash earnings, for me, I've always thought that statutory earnings are the true representation of Telstra if you're looking at profit, and cash earnings are really important if you're looking at dividends. So there is a place for cash earnings, but I did not like the emphasis today. And I've actually I think this is easily the best management team Telstra has ever had. That's why that was the reason we bought the stock back when it was in $3 something, and we've done quite well out of it. But it irks me that even a highly functioning management who hasn't really got any bad news to report still has to resort to these sort of tactics, and it tells you the state of our market.
I just find that it's weird that a big company like Telstra, and they must have, tens of people on their board, would treat investors with such disdain that they wouldn't notice. Do you know what I mean? The idea that you're not going to notice that revenue is in there. How stupid do they think people are?
Yeah.
Nick, what's your view on this?
Oh yeah, I mean, it's just crap, isn't it? I mean, when companies start changing the goalposts, and as you were saying, John, a company as large as Telstra trying to do it, you just have to question what was management thinking. And as Gaurav said, it wasn't like revenue halved; it was down 1%. I feel like it separates the good, maybe the great, honest managements from those that are sort of subpar as how they deal with a poor result and how they communicate it. And the fact that Telstra does this maybe suggests they're not the good, great management, on that side of the ball. But I don't have much to add except that it's pretty poor form.
Yeah. Gaurav, you said that dividends remain a bright spot, but the dividends being funded by debt.
Yeah, look, this was the other thing that really, I just don't, look, the cynical part of me thinks this really has to do with management sort of wanting to hit their incentives, because the stock trades at 24 times earnings and 10 times EBITDA, right? For reference, the historical, what I would pay for Telstra, so 6 times EBITDA, is what you'd pay for an established low growth but dominant and decent quality telco. That's internationally what we should pay, and that's historically what we paid for Telstra. So 10 times EV to EBITDA is a big number, big meaty metric. And they're buying that, and they just finished a $1.25 billion buyback. And what do again? They immediately launch into another $1 billion buyback. And that is the textbook correct answer. If you had asset consultants and capital allocation consultants come in, that's what they tell you to do.
Yeah.
I just think that's not the right move when you got like $17 billion of debt sitting there on your balance sheet, and to take another $1 billion out to do the buyback, which is completely funded by debt, mind you. It's just not the right move. And the fact that it's the consultant's move also says something about management. This is a very, look, I don't mean to say professional management is bad, but it's a world of difference from like an Ellison or XRF reported today. Like they got nice entrepreneurial management. There's a whole bunch of ASX companies that have entrepreneurial management, and this is clearly not going on at Telstra. They got consultant-like thinking all the way through that result, and it made it a very easy decision to sell that stock.
Yeah, I have a Portuguese friend I took a beach walk with this morning, and he got this expression called milking the cow. And I thought of that expression when I read your review yesterday, Gaurav, because Telstra are just milking the cow. You know, they don't have to do much. They just follow what the consultants say. They keep putting prices up. They've got a dominant monopoly. All they've got to do is manage it to the point where they don't get any attention from the ACCC, and they're going to be fine.
Yeah.
They're just milking the cow. And you can see the sort of attitude in this result and the way they've approached it. It's just, let's just keep squeezing this thing, see what we can do with it. Don't need to do anything ambitious. Don't need to do anything stupid.
Yeah.
We've got our monopoly. Let's just keep milking it.
Well,
that's what it looks like to me.
I am going to defend Telstra a little bit here, because over the last 20 years, they've actually tried to be ambitious, and that has equal to being stupid. They have probably the worst capital allocation record on the ASX, and I've been scathing of this business for years because of the stupid growth ideas that they've presented year after year. So it's nice to see that not happening. But look, these are minor gripes. It's not the worst thing in the world. It's just annoying to see such a largely well-run business. I mean, it's sort of a national pastime to be critical of Telstra, but this is a globally fantastic mobile business, one of the best mobile operators I've ever seen. And, I've covered telcos for a long time now. This is legitimately one of the best ones globally. And it's just annoying to see these little things pop up.
Just unnecessary tricks.
Unnecessary.
They don't need to do this in order to... carry on doing what they're doing. It just seems unnecessarily dumb to treat shareholders and potential investors in this manner. They don't need to do that. They can just be honest about the fact that it's a low growth business and they've got the best network and they make pretty good margins, and we're going to keep on increasing those margins and we're going to be fine.
Yep.
Don't need to do anything more than that.
Now you say it, John. Yep.
Milk the cow.
Milking the cow.
Yeah.
Milking the cow. All right, Nick, what cows have you been milking this week?
Oh, the one that's pissed me off this week is Seek. It was last week, but we just released the review this week, and there were really two things that pissed me off with this. First was the conference call. So I had another. I was looking at a couple other results, and I saw the conference call was going to be at 11, but nowhere did SEEK release this to the ASX. So there wasn't a phone number or a link to actually get to the conference call. So I ended up emailing investor relations, and they sent me the details, which was actually a dial-up call, not a link. So sort of back in the 2006 living, even though they're I guess purporting that their AI strategy is going gangbusters, but yeah, their tech is still 2 decades old. But that was the first problem, and then so I've joined the email list now, but I just thought it was a bit poor form that they didn't release this to all to the market, to all shareholders. And I'm making some assumptions here. I don't know if they have the email list of every shareholder, and every shareholder gets an email in the lead up to the result. But
it sounds unlikely.
I think that's pretty unlikely. I just thought that was it's really average. Every other company, particularly of $5 billion plus businesses, releases their webinar details to the market But it's now, I think, a couple of results in a row that Seek hasn't done this. And you can find the transcripts on CapIQ or online. But I just thought the whole experience was just terrible. Like it's
So why would they not do that?
look, I don't think they're trying to obscure anything, or I just think it's an oversight. There's someone hasn't thought of it, and have just sent it to the analysts, and the analysts will ask the questions. And if shareholders join in, that's great. If they don't, it doesn't matter. I think it's more an oversight, but still, it's a pretty average one, and it goes against what has become normal for large companies and even small companies as well, is to speak to their shareholders at least twice a year in February and August, and potentially another one at the AGM. And to hide that, I just thought was a bit average. But I don't think they're doing it on purpose. And hopefully that changes for the February result. The next one I think is probably worse, and this is to do with the Seek Growth Fund. It's actually probably the opposite of Telstra, whereas Telstra, as Gaurav said, didn't want to show revenue because it was bad. The CEO of Seek made this point of defending the Seek Growth Fund rather than trying to hide it away. And so, so he actually brought it to everyone's attention.
Have you no shame, sir?
Yeah, exactly right. So the growth fund is made up of pretty much human resource and education assets. It's worth about $1.6 billion to, or $1.5 billion to Seek, something like that. Mm-hmm. And it fell 13% during the year. It's also managed by their co-founder, Andrew Bassett, as well. So it's managed externally. So Seek's executive team don't have really a say in it, though they own the majority of it. Mm-hmm. And then, so it's fallen 13%, and the CEO comes on and says this is a very healthy result over the last 5 years, where the return in total has been 12%. They've earned over 12% over 5 years, which is a 3% return. I think they did an internal rate of return. So it's 3% per annum. And in what world is this acceptable? Like, in what world is this very healthy? I think a term deposit would have probably doubled that return. The ASX, I'm guessing, would have probably quadrupled that return. And these are stakes in companies that are very illiquid. Investors are taking, or shareholders of Seek are taking more risk with them. They expect higher returns, and then not getting them. And then to describe them as very healthy, I just thought it was just bizarre. Like, in what world is this very healthy? You'd hate to see what bad looks like if this is healthy.
Oh,
like,
yeah. My word.
It was just shocking. And the Seek Growth Fund has been like a huge question mark over Seek for a number of years. It's been this huge distraction because no one knows what it's worth. And I guess that's the other point here. That 12% return is based on marks of assets that are very illiquid and haven't been sold in software businesses that could be at risk of AI disruption. So that 12% return could actually be worse. It might be better too, but it could be worse. And I thought it was, that's probably my two biggest gripes with Seek.
It is weird to have that growth fund inside that structure.
Yeah, it is. It is.
The way I think about this, every time you have a deviation from the norm, it's always a deliberate decision. So you got to put yourself in the mind of management. Think, why have they deliberately done this? And this can be for something like small. So if the CEO has a ponytail, that is a deliberate decision, because CEOs typically do not have ponytails, right? So if you listening to a CEO and he's got his hair tied up in a man bun or something, like, he's decided, he's made the decision that, hang on, I'm not going to look like every other CEO. That tells you something about him, right? And equally, if the business has an unusual structure like Seek, it tells you something about where they're going, where they want to go, how they see themselves. There's information in there. So always look for something that's unconventional, because that's a deliberate choice. The default is just to do the conventional thing.
Yeah. And I think what they were trying to do, if you go back 5 years, was to simplify the business, right? So they wanted to put all these stakes they had. They wanted to keep ownership of them, but they didn't want the management team distracted by them so they could focus on the core Sikh job marketplace in Australia and their developing business in Asia. But it's just ended up being this sort of, I wouldn't quite call it a disaster. We don't actually know yet the result because these stakes haven't been sold, but it's just been a huge distraction because every call is now goes to the Sikh Growth Fund and goes, oh, how much do you pay in management fees? Are the stakes actually worth that? Like, when are you going to monetize this? Can you monetize it? And it distracts away from the actual Sikh business. And it's been an absolute shocker for them. And that they know shareholders are fed up with it and they're trying to exit it, but it's hard. They did make the point, and I'll give them credit here. They said, look, we're trying to exit $1 billion worth of stakes, but we don't know when because, they're liquid businesses and, they might be sold next week or it might take another year or two. We don't know. So at least they're trying to address it, but it's just been a shocker. And I just think a much better approach would be to just say, look, this hasn't really worked out as we thought it had. We're trying to exit it, and leave it at that, rather than saying, oh, it's a very healthy 12% return over 5 years. I mean, on what planet?
The fact that he used to run a bank and he thinks that that's a healthy return is it's a real warning sign, isn't it? Did any analyst ask, pull him up on that in the questions after?
No. There was the focus probably on the call concerning the Sikh Growth Fund was just about how and when they were going to monetize it, rather than that. And I do think, John, you bring up a good point though, because I think CEOs get away with this too often.
Absolutely, this is where I want to be angry about this, Nick. Don't steal my thunder here.
Okay.
I'm trying to set myself up for this.
I'll let you go.
All too bloody polite. They're all on the drip. And all the analysts are sitting there like being kind of nice, don't want to upset people because they know that if they upset people, then they won't get the calls. The calls won't be answered. They won't get invited to the lunches. There won't be the one-on-ones that they might have. So it's all too bloody polite. Nobody is prepared to piss anybody off. The fact that he describes those results as very healthy and they're clearly awful and nobody says anything tells you about the dynamic between management teams and the analytical community in inverted commas. It's just very, very cozy and it's very unhealthy because you do not get genuine critiques or questions that actually annoy management or piss them off a little, but actually get to the truth of what's going on.
Ditto.
No, agreed.
Okay, then should we end it there? 22 minutes.
Hang on, I wanted to pull up Nick about his rant about the growth fund I'm behind. I don't agree with the conference call stuff. I actually like calls and AGMs that are behind closed doors that are unrecorded. I find it that's the only way to get management to actually say something. If you listen to management in a public forum where they're being recorded, they just say nothing. Unless you're Ellison, you say nothing. Because you don't want to be called up. You don't want to be caught out in something. And a recording changes your behavior. It changes what you're prepared to say. So I actually like, I prefer it when these things are closed and not recorded. And that it's inconvenient and it's annoying. But if you can get yourself there, it's ultimately far more rewarding.
But do you think that in general, as a principle, if you're recording calls and you're producing transcripts and everybody has access to that, is that generally a good thing?
Of course.
Because if you allowed everybody to do behind closed doors meetings, because they're more useful because people talk more freely, so you have to go to the AGMs, then, I mean, I hate to use that phrase market efficiency because, in this kind of area, there isn't that much market efficiency, I don't think. But wouldn't we all generally suffer from not having these things made available?
Yeah. No, this is the paradox, isn't it? Because I prefer the meetings I can't get to, I want to have online access, but the ones I can get to, I want to have a closed door meeting with no one else there.
Okay.
That's the way it works, John. Get it right.
That's kind of a weak argument, I think.
It's I want these again, for lack of a better term, these inefficiencies to exist for myself.
You need
not for anybody
inefficiencies.
else.
Yeah. It's hard enough. It is getting so hard to outperform, partly because of all this passive money, but also because technology has taken away a lot of the inefficiencies that used to exist. The analytical efficiencies.
I don't feel as though that's true. Like, you look at the recommendations we've made over the past few years, we've had no trouble finding inefficiently priced stocks.
Yeah, there's a lot of work, John.
I know, of course, it's a lot. It's always been a lot of work.
No, I feel like it used to be easier. You could use. I remember when I first started here. That was a stage you could still do screens, and screens would still work because everyone didn't have access to numerical databases. And you could still screen for stocks. If you're sitting there screening for stocks, you're wasting your time. The computers are way ahead of you. It's very hard now. I think the edge now is completely psychological. The edge now is in actually. I think Nick and I probably disagree on this, but I actually think a lot of people think small caps give you the edge because there's information asymmetry. People aren't paying attention. I actually think it's the other way around. The edge is when everyone's looking at a stock. There's a tendency for opinions to herd. And if you can find a herded opinion that's incorrect, that is what I'm looking for now. It's not the uncaptured small stock that no one's heard of, that's getting ignored, that's not getting analyst coverage. I think that's a unicorn that just does not really exist anymore.
What about you, Nick? Gaurav says you disagree.
Yeah, no,
Before you've even spoken.
Yeah, I actually tend to agree, though I do think there might be a unicorn or two left out there. But no, I think what's changed is just the composition of investors in markets and the time horizons. So there is more and more money looking at what the next quarter or what the next half's earnings is going to be, or what the next catalyst is going to be, and chasing that. And it's very, very short-term orientated. And I think if you can be patient, and as Gaurav said, think about things a little bit differently, but be patient and look out and see what this business can do in 3 or 4 years. I don't think there's as many people doing that as there once was. That's hard to do, but I actually think having a longer time frame than a day or 3 months is probably one of the biggest edges still around, and it's probably getting bigger because like, look at the money going to these US style hedge funds that are pretty much just traders. Like, that's what they're doing. They're not trying to work out what Eagers can do in the Canadian acquisition in 5 years. That doesn't even cross their minds. They're working out what maybe EV sales are this week and whether it's going to affect Eagers sales next week. Like, it's very short term orientated, and I think if you can take a longer term time horizon, that's the biggest advantage.
Do you agree with that, Gaurav?
I don't think it's the biggest advantage, but I agree that advantage is getting more and more important. I mean, I think that's always been the case. So if you read those old books, time arbitrage is a long-standing idea, but I do agree that it's becoming more important now, and that largely reflects the rise of passive money. And everyone calls it passive money. The correct word for it is stupid money, because it is unthinking money. It just buys things unthinkingly. I don't mean that in a negative sense. You're not dumb for putting your money in passive. It's for most people the sensible thing to do, but when in aggregate, that pool of money is dumb. And that's what's driving the edge. That's what creates the herding behavior. And Nick, I agree, that's what creates the greater gap in time arbitrage.
And it extends those periods of momentum. When you see a momentum behind a stock, it's an accelerant to that.
Yeah, and that drives also prices, which then drives narrative, which kind of creates a loop on itself. There are still opportunities. They require much more psychological fortitude. I feel as though I've been forced to become a much more of a market animal to generate returns, and less analytical and rational. Those things worked in the past, and they're less effective now. It's just harder. It's harder. When you see your stocks kind of halve and double very quickly, to remain impartial and rational and data driven is harder.
And so Nick thinks time is time period is one of our big advantages. You said you thought it was one of them. What do you think of the others?
Oh, I think the psychological edge is still the best, and that is hard to pin down, but it comes with experience and it comes with personality. There are some people who I've met who are just very, very smart, but who just do not have the mental psychological fortitude to be investors. Like they can't handle it because it demands a lot from you. It demands discipline and restraint and the ability to look like an idiot for a long time, which I can put my hand up and say I'm very comfortable doing that.
I've made no career out of it.
Yes, John, you have made a career out of it. But quite seriously, looking, being unafraid of failure is, I think, the single most important part of this game. And so many, I'd say 95% of people just terrified of getting things wrong and failing. And we've seen that when we try to hire people. The number one reason why it's so hard to hire people for this job is because you're making publicly facing recommendations and 95% of them can't take it, can't handle being wrong. And that turns them timid and afraid. It influences their psychology, influences their analysis, and ultimately influences their returns. And
it's one thing to lose your own money. It's another thing altogether to lose somebody else's money.
And I think it's also being scrutinized for it as well. Yes. Every decision being under scrutiny.
I would say the psychological thing that you're talking about, Gaurav, and that time horizon, I think they're actually linked to a degree. If there's, and I when I say there's a lot of money chasing these short-term results, I'm not just talking about passive. There is a lot of active managers now with momentum strategies.
Yes.
And looking at that little data point, that's sort of what I'm more speaking to. And then the passive money comes in and follows what they do. But to have a long-term time horizon now and to be patient, you have to have some emotional fortitude because you're going to see stocks that fall 10% because they missed some pointless number for last year's earnings, even though the management is there telling you, oh, look at this, all the blue skies, all the opportunities we have. And I think that requires both. You have to have the right emotional balance, but you also have to have that, ability to look past just the share price and whatever, today's news is.
Yeah. So we learned that Gaurav thinks that all AGMs should be held in his personal Faraday cage. Nick, what's your one big takeaway from this discussion for people listening?
3% per annum is not a good return when interest rates are at closer to 5%.
Okay, I think on that note, we will leave it there. It's been nice having you, Nick. Get back to reporting season, Gaurav, and we will be back in 2 weeks.